The stock prices of most small regional banks have become more attractive in the past 1 year. Do you have any opinions about regional banks as investments? And if you were going to purchase shares, what are the areas that you would carefully examine?
Yeah, I don't think you should make a categorical decision about something like, however you define them, small, mid-cap, whatever, regional or national banks for that matter. So much depends on the character of the institution, which will probably be a reflection to a great degree of the type of CEO you have. And a bank can mean anything. It can mean an institution that's doing all kinds of crazy things. There was one called the Bank of the Commonwealth up in Detroit many years ago that went to extremes, and it was very popular in Wall Street for a while. It could mean the soundest of institutions. We owned a bank, the only bank Berkshire's ever owned in its entirety, in Rockford, Illinois, run by a fellow named Gene Abegg. And it wouldn't make any difference whether it was a super regional or a small or a mid-cap bank. There's no way Gene Abegg could run on anything other than a super sound bank. So I think you should know something about the culture of the99% and the institution to make a firm buy decision on a bank. And that's hard to do for 99% of the banks. We own stock, as you know. It's in our report, Wells Fargo and U.S. Bank and M&T up in Buffalo. And in all three cases, I think I understand quite well the DNA of the institution in terms of how it behaves. That doesn't mean those places are immune from problems, because they'll have problems. But it does mean they're immune, in my view, from what I would call institutional stupidity. And I would not say that all banks are immune from that. As a matter of fact, there was a very wise man named, I think it was Morris Cohen, that said there are more banks than bankers. And if you think about that a while, you'll get my point. Charlie?
Well, I think the questioner is onto something. So many of our very large banks, both here and in Europe, have sort of cast a pall of disgrace over the whole industry. And that has undoubtedly pounded down the stocks of some small banks that there's nothing at all wrong with. So I think you're prospecting in a likely territory.
Yeah, but you can find a few big banks.
Yes, big banks too, yeah.
And I don't know if you took the 20 smallest banks in Florida and the 20 largest banks in Florida, which group would be in better shape in terms of the Florida real estate situation.
It's a territory that has some promise.
That is a wildly bullish statement from Charlie. Number 7. I'm going to go out and buy that stuff as soon as we get out of here.
That's a very good question, but I would say that the one thing that made Chairman Powell's job a little easier this time than it was in 2008-9 is that the banks are in far better shape. So in terms of thinking about what was good for the economy, he wasn't at the same time worrying about what he was going to do with Bank A or Bank B to merge them with somebody else or added strains on the system or anything. I mean, the banks were very involved with the problem in 2008 and 9. They had done some things they shouldn't have done in some of them, and they were certainly in far different financial condition now. So that the banking system is not the problem in this particular. So I mean, the government we decided as a people to shut down part of the economy in a big way, and it was not the fault of anyone that it happened. Things do happen in this world. Earthquakes happen. Huge hurricanes happen. This was something different. But the the banks need regulation. I mean, they benefit from the FDIC, but part of having the government standing behind your deposits is to behave well, and I think that the banks have behaved very well, and I think they're in very good shape. I mean, that's why the FDIC has built up $100 billion that I've talked about. I mean, they've assessed the banks in recent years at accelerated amounts in certain periods, and they even differentiated against the big banks. So they built up great reserves there, and they built their own balance sheets, and they are not presently part of Chairman Powell's problem, whereas they were very much part of Chairman Bernanke's problem back in 2008 and 9. How you spot the people that are doing the dumb things is not easy because, well, sometimes it's easy, but I don't see a lot that bothers me. But banks are, in the end, institutions that operate with significant amounts of other people's money, and if problems become severe enough in an economy, even strong banks can be under a lot of stress, and we'll be very glad we've got the Federal Reserve System standing behind them. I don't see special problems in the banking industry now. I could think of possibilities, and Jamie Dimon referred to this a little bit in the J.P. Morgan report. You can dream of scenarios that puts a lot of strain on banks, and they're not totally impossible, and that's why we have a Fed. And I think overall the banking system is not going to be the problem. But I wouldn't say that with 100% certainty, because there are certain possibilities that exist in this world where banks could have problems. They're going to have problems with energy loans. They're going to have problems. They're going to have extra problems with consumer credit. They're going to have, they're in, but they know it, and they're well reserved. Well, they're well capitalized for it. They were reserve building in the first quarter, and they may need to build more reserves, but they are not a primary worry of mine at all. We own a lot of banks, or we own a lot of bank stocks.
Yeah, Wells Fargo and U.S. Bancorp are both among the best large banks, if not the best, in the country, and they're different than what you think of in terms of some money center banks, but they're very large. Wells is 4 times as large as USB. Banking as a whole, U.S. banking profitability will be considerably less, in my view, in the period ahead than it was, say, in the early part of this century. And a very important reason is that the leverage will be reduced. And that's probably a good thing for society. It may be a bad thing for individual banks that could use leverage intelligently, but the trouble was that they all thought they could use leverage intelligently, and the actions of one or more that were unintelligent about it had consequences for everybody, which you can see if you view HBO on whatever it is. Is it May 26th then? So I would say that return on assets, even if return on assets were as good as it was some years ago, there will be less assets per dollar of common equity than before, which means return on common equity will be less. We still think that Wells Fargo and U.S. Bank are very good operations. We think they're very decent businesses. They're not as attractive as when leverage ratios could be higher. In terms of the troubles in banking, the I think you've seen by far the worst in the past, and loan losses have been trending downward now for several quarters. And I think the expectation is that will continue. And I think banking is a very fundamental business. But as John Stump said a few years ago at Wells Fargo, he said, I don't know why we keep thinking of new ways to lose money when the old ones were working so well. And banks periodically go crazy. It's always on the asset side. I mean, here you've got cheap money. You've got the federal government behind, although the federal government has never had to pay out anything in terms of the FDIC. The FDIC has handled 3,800 since it was established in January 1st, 1934. The FDIC has paid out probably 3,800, 3,900 by now institutions, 250 of them or so in the last couple of years. And that has not cost the U.S. taxpayer a penny. I mean, that has all come from FDIC assessments on other banks. It's been a mutual insurance company. So the banking, if you just keep out of trouble on the asset side, is a very good business because you get your money so cheap, and because of the implicit federal guarantee, and you do get to leverage up to a fair extent, and America's been a pretty good place to lend money. So I like our positions in there. You will see that if you looked at those totals, you'll see we've added to Wells Fargo, and I think both those companies are very well-run institutions, but they will not be able to earn, I don't know what the figures were, but I think they were up in 25 or to 30% on tangible equity, and that's not going to get repeated in the future, and it shouldn't be. Charlie?
Well, yeah, we might add that M&T Bank, which most people never talk about, is headed by a really sensible fellow. And it's been a wonderful investment for us.
Yeah, as a matter of fact, if you'll get the M&T annual report, it's written by Bob Wilmers, the letter. The first part of it's about M&T specifically, but the second part is about particularly the American financial economy. And I would really recommend you read that. Bob is a very smart guy, and he has a lot of good observations. And frankly, the other one I'd recommend you read is Jamie Dimon's letter at J.P. Morgan is a tour de force in terms of describing the banking scene, the economic scene. He has some real insights in there about some very important subjects. We don't own that stock, but it's a letter that I think everybody could learn a lot from reading, as they could from reading Bob Wilmer's letter at M&T.
Yeah, and those people who like an element of morality in business, Wilmer sounds like an Old Testament prophet. I mean, he really doesn't like it that all the really big banks are making so much money out of trading, because he says you're really trying to outsmart your own customers, and he'd rather serve them in a culture of deserved trust in both directions. It's hard to think he's totally wrong.
He also expresses quite a dislike for the fact that a market system creates a reward system where money sort of disproportionately flows to people who work with money, and that tends to attract a disproportionate number of people that of lots of ability that he thinks might be, at least some of them might be better deployed elsewhere. It's an interesting read.
Yeah, it's one of the best annual reports that's ever come out of banking, right out of Buffalo.